Before we dive in, please remember that I am not a financial advisor, and this presentation is for educational and informational purposes only. The information shared here is not financial, legal, or tax advice. You should always consult with a licensed professional for advice tailored to your individual situation. Your home is likely your largest asset, so making informed decisions with an expert is absolutely critical. There is a secret bank account in your name with tens, maybe even hundreds of thousands of dollars in it. You are the only person with access. But there's a catch. The bank never gave you the instructions. This isn't some offshore account. It's the equity trapped inside the four walls of your home. You feel it every day. You see the kitchen that's stuck in the 90s, you get the tuition bills for your kids' college, or you feel that pit in your stomach from high-interest credit card debt that just won't go away. You know the money to fix these problems is right there, locked in your property. But the fear of making the wrong move, of choosing the wrong loan, of getting buried in paperwork and jargon, it's paralyzing. So you do nothing. And that inaction is costing you a fortune. Today that paralysis ends. I'm going to hand you the two master keys to that bank account: the mortgage and the home equity loan. They look similar, but one is designed for building a foundation, and the other is for strategic withdrawals. Using the wrong key at the wrong time isn't just a mistake. It can be a financial catastrophe that could put your very home at risk. By the end of this video, you will not only understand the fundamental difference between these two powerful tools, you will have the clarity to begin asking the right questions to determine which path is right for you, your family, and your financial future. We're going to demystify the jargon, break down the numbers, and give you the confidence you've been looking for. Let's start with the treasure itself, your home equity. Forget the complicated bank definitions. I want you to picture your house as a giant glass piggy bank. When you first bought it, let's say for $400,000, the bank filled it almost to the top with their money. That's your mortgage. You only put in a tiny sliver of your own cash at the bottom, your down payment. Let's say you put down 20%, which is $80,000. That $80,000 is your starting equity. It's the only part of the piggy bank that is truly yours. Now, two magical things start to happen over time. First, every single month you make a mortgage payment. A piece of that payment chips away at the bank's money and converts it into your money. You're literally buying back your piggy bank 1 month at a time. Second, while you're busy paying down the loan, the housing market is working in the background. Your neighborhood gets more desirable, homes around you sell for more, and the total value of your piggy bank starts to grow. Maybe after 5 years, your $400,000 home is now worth $500,000. That extra $100,000 in value? That's all yours. It gets added directly to your portion of the piggy bank. So let's do the math. You started with $80,000. You've paid down, say, another $30,000 of your loan, and the house appreciated by $100,000. Your equity, the money that is 100% yours, is now $210,000. That is the cash sitting in your secret bank account. It's the wealth you've built, and it's the money that banks are more than willing to let you borrow against. Now, banks have a term for this relationship between what you owe and what your house is worth. It's called the loan-to-value ratio, or LTV. It's one of the most important numbers in real estate lending. If your home is worth $500,000 and you owe $290,000, you divide the loan by the value. Your LTV is 58%. This number is like a safety gauge for the bank. The lower your LTV, the more equity you have, and the safer their investment in you is. This is why banks love homeowners with low LTVs. It means you have a lot of skin in the game, and they're more willing to lend you more money against that security. So, how did we get here in the first place? With the original key, the mortgage. A mortgage is brutally simple in its purpose. It is a loan used to buy a property. That's it. It's the tool you use to get your foot in the door of homeownership. Think of it as the foundational loan. Without it, the house wouldn't be yours. Now, every mortgage, whether it's a 30-year fixed or a 15-year ARM, is built on 3 pillars: principal, interest, and term. The principal is the big number. It's the total amount you borrowed from the bank to buy the house. In our example, that was $320,000. The interest is the price you pay for borrowing that money. It's the bank's profit for taking the risk on you. And the term is simply how long you have to pay it all back, most commonly 30 years in the United States. And of course, for most homeowners, that monthly payment isn't just principal and interest. It's PITI, principal, interest, taxes, and insurance. Your lender often collects your property taxes and homeowner's insurance in an escrow account every month and pays them for you. just to make sure the asset, your house, is protected. So while the core loan mechanics are just principal and interest, your actual monthly check is usually a bit bigger to cover these other essential costs of ownership. Now here is the single most important concept to understand about your mortgage, something most homeowners don't fully grasp. It's called amortization. It sounds complicated, but it's just a fancy word for how your payments are structured over time. Imagine a seesaw. On one side you have interest, and on the other you have principal. When you make your very first mortgage payment, the seesaw is tipped heavily towards the bank. The vast majority of your payment, maybe 70 or 80%, goes straight to paying off interest. Only a tiny sliver actually reduces your loan balance, your principal. But with every payment you make, the seesaw slowly, almost imperceptibly, begins to tip. Month after month, year after year, a little less goes to interest, and a little more goes to principal. By the time you get to your final few years of payments, the seesaw has completely flipped. Now, almost your entire payment is pure principal, crushing your remaining debt at an incredible speed. Why does this matter? Because understanding this amortization seesaw is crucial. It shows you that in the early years of your loan, you're not building equity very fast through payments. Most of your equity growth will come from market appreciation. It also explains why refinancing your mortgage can be so powerful, or potentially so costly, because it often means resetting that seesaw all the way back to the beginning. Okay, so you get it. You bought a house with a mortgage. You've been paying it down, the market has been good, and now you have a significant chunk of equity, that $210,000 sitting in your piggy bank. And you need cash. The credit card bills are piling up, the roof is leaking, or you have a once-in-a-lifetime investment opportunity. You need to tap into that wealth. This is the critical fork in the road where millions of Americans get confused and make the wrong turn. You have two primary options to access that money. Option 1 involves the key you already have, your original mortgage. You can choose to trade it in for a new one, a process called refinancing. This is like turning in your old car key and getting a brand new one for a slightly different car. It can be a powerful move to lower your interest rate or pull out a large lump sum of cash. Option 2 involves getting a brand new second key. This key doesn't replace your original mortgage. It works alongside it. This second key is a home equity loan, or more commonly a home equity line of credit known as a HELOC. This isn't a lump sum loan. Think of it less like a key and more like a credit card that's secured by your house. You get a credit limit, say $100,000, and you can draw from it, pay it back, and draw from it again as you need. It offers incredible flexibility, but it also comes with a completely different set of rules, risks, and benefits. One is a fixed, predictable installment loan. The other is a variable, revolving line of credit. One resets your entire financial foundation. The other adds a new layer on top of it. Choosing the wrong one for your specific need, using the flexible credit card when you needed the stable lump sum, can lead to payment shock, years of extra debt, and in the worst-case scenario, foreclosure. So how do you choose? How do you know when to refinance your mortgage versus opening a HELOC? That is the million-dollar question, and it's exactly what we're going to break down next. To figure this out, we need to stop thinking about these as just financial products and start thinking about them as tools. You wouldn't use a sledgehammer to hang a picture frame, and you wouldn't use a tiny screwdriver to break down a wall. The tool has to match the job. The first, most critical question you have to ask yourself is, why do I need this money? The answer to that question will point you in the right direction more than anything else. Let's start with the number one reason people tap their home equity: debt consolidation. You've got high-interest credit card debt, maybe a personal loan, a car payment, and it feels like you're being attacked from a dozen different directions every month. The idea of rolling all of that into one single lower-interest payment is incredibly appealing. So, which tool do you use? A cash-out refinance can be a fantastic sledgehammer for this job. Let's say you owe $200,000 on your mortgage, and your home is worth $400,000. You also have $50,000 in high-interest debt. You could refinance your entire mortgage for $250,000. You'd get a check for that $50,000, you'd wipe out all your other debts instantly, and you're left with just one monthly mortgage payment. And this is a huge if current mortgage rates are lower than what you're paying now, this is a home run. You get cash out and you lower the rate on your primary mortgage. It's clean, it's simple, and the payment is fixed for the next 30 years. You know exactly what to expect. But what if mortgage rates today are higher than your current rate? Maybe you locked in a historic 3% rate a few years ago. Refinancing to 7% just to pull out $50,000 would be financial suicide. You'd be raising the interest rate on the entire $200,000 balance just to get access to that $50,000. This is where the HELOC, the screwdriver, becomes the smarter tool. You leave your amazing 3% mortgage completely untouched. You open a HELOC for the $50,000 you need, and you only pay interest on that amount. Yes, the HELOC rate will likely be higher than a new mortgage rate, and it will be variable, but it's a much smarter move than poisoning your fantastic primary mortgage. You're isolating the new, more expensive debt instead of letting it infect your entire financial picture. Now let's look at the second biggest reason: home improvements. This is where the structure of these loans really starts to matter. Are you doing one massive project or a series of smaller ones? Let's say you need a new roof and you have a contractor's quote for exactly $35,000. It's a one-time predictable expense. A cash-out refinance could work perfectly here, especially if rates are favorable. You get the lump sum of cash, you pay the roofer, and you're done. Your payment is predictable and stable. But what if you're renovating your kitchen, and you plan to do it in phases over the next 2 years? You're doing the cabinets now, the countertops in 6 months, and the appliances next year. You don't need all the money at once. This is the absolute sweet spot for a HELOC. A HELOC is a line of credit. Think of it like a credit card secured by your house. The bank might approve you for a $75,000 line of credit, but you don't have to use it all. For the kitchen project, you just draw what you need for the cabinets. You only pay interest on the money you've actually taken out. 6 months later, you draw more for the countertops. This flexibility is the HELOC superpower. You're not paying interest on a huge lump sum of cash that's just sitting in your bank account waiting to be used. You use it as you need it, which can save you a fortune in interest payments. This brings us to the fundamental difference in how they're structured. Lump sum versus a line of credit. A refinance is a one-and-done transaction. You get a pile of cash and your loan balance is set. A HELOC is an open-ended tool you can use for years. Most HELOCs have what's called a draw period, which is usually 10 years. During this decade, you can borrow money from the line, pay it back, and borrow it again over and over without having to reapply. It's like having a financial safety net. A surprise medical bill comes up, you can tap the HELOC. Your car suddenly dies, tap the HELOC. It gives you incredible peace of mind and flexibility. But that flexibility comes with a very serious catch, and that is the interest rate. This is the second critical question. Are you comfortable with a fixed rate or a variable rate? A mortgage refinance is almost always a fixed-rate loan. Your 6.5% interest rate today will still be 6.5% in 20 years. It is the definition of stability. You can budget for it perfectly. A HELOC, on the other hand, is almost always a variable rate loan. The interest rate is tied to a benchmark, usually the U.S. prime rate, which is heavily influenced by the Federal Reserve. So when you hear on the news that the Fed raised interest rates, your HELOC payment is about to go up. When you first open a HELOC, the bank might offer you a very attractive, low introductory rate. But once that period ends, your rate will float. If the prime rate is 8%, your rate might be prime plus 1, meaning you're paying 9%. If the Fed raises rates and the prime rate goes to 9%, your rate automatically jumps to 10%. This is the central risk of a HELOC. The low monthly payment you started with can balloon over time, becoming much more expensive than you ever anticipated. With a fixed-rate refinance, you are locking in your costs for decades. With a HELOC, you are making a bet on the future of interest rates. Finally, you have to consider the timeline and the costs. Getting a cash-out refinance is a lot like getting your original mortgage. It's a heavy lift. There's a full application, underwriting, and appraisal, and it can take 30 to 60 days to complete. And crucially, there are closing costs. You can expect to pay anywhere from 2% to 5% of the new loan amount in fees. On a $250,000 refinance, that could be $5,000 to over $12,000 in closing costs, which is often rolled right back into your loan. A HELOC is typically much faster, easier, and cheaper to set up. Some lenders offer zero closing cost HELOCs, and the application process can be completed in just a few weeks. It's a much more nimble and accessible tool. So let's turn this into a simple checklist. Ask yourself these questions. 1. Why do I need the money? Is it for a single large known expense? That leans toward a refinance. Is it for a series of smaller, unknown, or ongoing expenses over time? That leans heavily toward a HELOC. 2. What is the interest rate environment? Are current mortgage rates significantly lower than your existing mortgage rate? If yes, a refinance is incredibly attractive. If rates are higher, a refinance could be a colossal mistake. and a HELOC becomes the default best option to protect your low primary rate. 3. What is your tolerance for risk? Do you need to know with 100% certainty what your payment will be every single month for the life of the loan? If you crave that stability, the fixed-rate refinance is your answer. Or are you comfortable with a payment that can change over time in exchange for incredible flexibility? If so, the HELOC is for you. Making the right choice here is about a clear-eyed assessment of your specific situation, your project, and your personality. There is no single better option. There is only the better option for you. But understanding this framework is only half the battle. Because hidden within both of these powerful financial tools are traps, subtle clauses, hidden fees, and long-term consequences that can turn a smart financial move into a decade-long nightmare. And the most dangerous of these is something called payment shock, a feature of HELOCs that has blindsided millions of homeowners. We'll uncover exactly what that is and how to avoid it next. Payment shock is the financial equivalent of stepping on a rake in the dark. You're walking along feeling confident, and then bam, you're hit with a sudden, painful, and completely unexpected blow to your budget. It happens when a home equity line of credit, a HELOC, transitions from its first phase to its second. You see, almost every HELOC is split into two distinct periods: the draw period and the repayment period. The draw period is the honeymoon phase. It's typically the first 10 years. During this time, the HELOC acts like a giant credit card secured by your house. You're given a credit limit, say $100,000, and you can draw from it as you please. Need $20,000 for a kitchen remodel? Done. $10,000 to consolidate credit card debt? Easy. You only pay interest on the amount you've actually borrowed. And here's the seductive part. During this draw period, many lenders only require you to make interest-only payments. Let's imagine you've drawn $50,000 at a 5% interest rate. Your monthly payment would only be about $208. Feels incredibly affordable. You're accessing tens of thousands of dollars of your home's equity, and the monthly cost feels like a utility bill. This is the feature that makes HELOC so popular. It's flexible, it's cheap, or so it seems, and it gives you a powerful sense of financial freedom. You're not paying back a single penny of the actual money you borrowed, the principal. You are simply treading water, paying the bank for the privilege of using their money. And for 10 years, that can feel like a pretty sweet deal. But the draw period always ends. And when it does, the repayment period begins. This is when the rake swings up and hits you in the face. The party is over. Your ability to draw more money is shut off. And now the bank wants its money back. All of it. Over the remaining term of the loan, typically 20 years, your payment is recalculated. It's now fully amortized, which is a fancy way of saying you have to pay back both the principal you borrowed and the interest every single month. Let's go back to that $50,000 balance. Your interest-only payment was a comfortable $208 a month. But now, in the repayment period, you have to pay that $50,000 back over the next 20 years. Assuming that same 5% interest rate, your new monthly payment would be $330. That's a 58% jump overnight. But it gets much, much worse. Because there's another hidden trap inside most HELOCs: the variable interest rate. Unlike a fixed-rate mortgage where your rate is locked in for 30 years, a HELOC's rate is tied to a benchmark, like the prime rate. When the Federal Reserve raises interest rates to fight inflation, the prime rate goes up, and so does the interest rate on your HELOC. It's not a matter of if your rate will change, but when and by how much. So let's rerun our scenario with a more realistic, modern-day twist. Imagine a family, the Jacksons. In 2014, they took out a $100,000 HELOC when interest rates were at historic lows. They got a great introductory rate of 3.5%. Over the next decade, they used $80,000 from it. They put in a new pool, paid for their daughter's college tuition, and took a once-in-a-lifetime trip to Europe. For 10 years, their interest-only payment on that $80,000 was about $233 a month. It was barely a blip on their financial radar. Now it's 2024. Their 10-year draw period is over. The payment shock is coming. But it's a double whammy. Not only do they have to start paying back the $80,000 principal, but interest rates have skyrocketed. Their variable rate, once 3.5%, is now 9%. Let's do the math. The bank recalculates their payment. They owe $80,000, the term is 20 years, and the new interest rate is 9%. Their new monthly payment is $719. Let that sink in. Their payment went from $233 to $719. It more than tripled instantly. That is payment shock. It's an extra $500 a month that their budget simply wasn't prepared for. Suddenly, the memory of that European vacation feels a lot more expensive. The pool in the backyard starts to look like a concrete money pit. This exact scenario has been a primary driver of foreclosures in the United States. During the housing boom of the mid-2000s, people used their homes like ATMs. When the market crashed in 2008 and their draw periods began to end a few years later, millions of Americans were hit with payment shock on a home that was now worth less than they owed. They couldn't pay and they couldn't sell. It was a financial prison. So how do you avoid this nightmare? How do you use a HELOC smartly without falling into the trap? First, you must understand your loan's terms inside and out before you sign anything. Ask the lender directly. When does my draw period end? What is the formula for my variable rate? Is there a cap on how high my interest rate can go? What will my fully amortized payment be on my expected balance when the repayment period begins? Get them to calculate it for you. Second, stress test your own budget. Don't just ask if you can afford the tiny interest-only payment. Ask yourself if you can afford the fully amortized payment at an interest rate that's 3, 4, or even 5% higher than it is today. If the answer is no, you are taking on a massive risk. You are betting your home on the hope that interest rates will stay low for a decade or more, and that is a bet that history has shown to be a losing one. Third, treat the principal like the serious debt it is. Just because the bank only requires an interest-only payment doesn't mean that's all you should pay. During the draw period, make a habit of paying extra towards the principal every single month. Even an extra $100 or $200 a month can dramatically reduce your balance over 10 years, which will soften the blow of payment shock when it inevitably arrives. The goal should be to enter the repayment period with as small a balance as possible. Finally, have an exit strategy. A HELOC is a tool, not a solution. It's best used for short-term needs with a clear plan for repayment. Maybe you're using it to renovate your home with the intention of selling it for a profit in 5 years, at which point you'll pay off the HELOC entirely. Or maybe you're using it to bridge a temporary income gap and have a plan to pay it down aggressively once your income stabilizes. Going into a HELOC with a vague idea of paying it back someday is how you end up like the Jacksons, facing a tripled payment you can't afford. The HELOC offers incredible flexibility, but that flexibility comes with profound risks. It demands discipline and foresight. The traditional 30-year fixed-rate mortgage, by contrast, is the epitome of predictability. Your principal and interest payment is precisely the same in month 1 as it is in month 360. It's boring, it's rigid, but it will never give you payment shock. So you've dodged the HELOC payment shock, and you're feeling safe with your predictable 30-year mortgage. But what if I told you that for the first decade of that mortgage, you're barely paying down your loan at all? You're mostly just paying the bank. We're going to break down the amortization schedule, a document that reveals the brutal front-loaded truth about where your money really goes in the early years of a mortgage, and why it's designed to make the banks incredibly rich. This document, the amortization schedule, is the bank's playbook. It's the secret map to your financial future, and they hand it right to you at closing, knowing full well that 99% of people will glance at it, be overwhelmed by the sheer number of pages and columns, and then file it away forever. But not us. Today we're going to read their playbook, and we're going to understand exactly how the game is played. Amortization is just a fancy word for paying off a debt over time in equal installments. Each of those installments, your monthly mortgage payment, is made up of 2 parts: principal and interest. Think of it like this: principal is the money you actually borrowed to buy the house. It's the part that builds your equity, the part that represents your actual ownership. Interest is the fee you pay the bank for the privilege of borrowing their money. It's their profit. It's the cost of the loan. Now, you'd logically assume that if your payment is, say, $2,500, a good chunk of that would go to paying down your loan, right? Maybe it's split 50-50, or maybe even 60-40 in your favor. That's what feels fair. But the system isn't designed to be fair. It's designed to be profitable for the lender. And the key to that profitability is a concept called front-loaded interest. Let's put some real numbers to this, because that's when the scale of this becomes shockingly clear. Imagine you take out a $400,000 mortgage for 30 years at a 6.5% interest rate. Your monthly principal and interest payment would be about $2,528. Now let's look at your very first payment. You write that check for $2,528 feeling proud. You're a homeowner. You're building wealth. But where does that money actually go? The bank calculates the interest first. They take your outstanding loan balance, which is the full $400,000, and multiply it by your interest rate of 6.5%. That gives them the total interest for 1 year. Then they divide that by 12 to find out how much interest you owe for that first month. The math is simple. $400,000 times 0.065 divided by 12 equals $2,166.67. Let that sink in. Of your $2,528 payment, a staggering $2,166 is pure interest. It vanishes into the bank's pocket. It does absolutely nothing to pay down your loan. The remaining amount, a tiny $361.33, is all that goes towards your principal. You just handed the bank a briefcase with over $2,500 in it, and they handed you back a few hundred in home equity. You've essentially just paid the bank $2,166 for a 1-month rental on your own money. And it gets worse. Let's look at the entire first year. You will make 12 payments of $2,528 for a grand total of $30,336 out of your pocket. You've paid the bank over $30,000. At the end of that year, how much do you think you've paid off on your $400,000 loan? Maybe $10,000 or $15,000? No. After paying over $30,000, your loan balance has only decreased by about $4,460. You heard that right. You paid $30,336, and you own less than $5,000 more of your home. The other $26,000 is gone forever. It's the bank's revenue. It's the price of admission to the homeownership club, and the dues are brutally high in the beginning. This isn't an accident. This is the design. The bank structures the loan this way to minimize their risk and maximize their early returns. They get their profit, the interest, back first. If you decide to sell the house or refinance after just a few years, which millions of Americans do, the bank isn't worried. They've already collected tens of thousands of dollars in pure profit from you. They've won. Let's fast forward 5 years into our example. By now, you've been a diligent homeowner. You have made 60 payments on time every single month. That's 60 times $2,528. You have paid the bank a grand total of $151,680. That's enough money to buy a Porsche, a boat, or put another kid through a few years of college. After paying over $150,000, your $400,000 loan balance has been reduced to about $376,000. You have only paid off $24,000 of your actual loan. Let me repeat that. You paid the bank over $150,000, and you got $24,000 in equity for it. The other $127,000 was interest. It evaporated. It became a number on a quarterly earnings report for a bank's shareholders. This is the brutal truth of the amortization schedule. It's a financial treadmill. For the first 5 to 10 years, you are running as fast as you can, making these huge monthly payments, but your forward progress toward actually owning your home is agonizingly slow. The bank is collecting almost all of its profit from you up front, while your debt remains massive. This is why it feels impossible to get ahead. Because the interest you pay each month is calculated based on your remaining balance. And since your balance goes down so slowly at the start, the interest portion of your payment remains incredibly high for years and years. So what is this different way? What's the tool that breaks you out of this financial prison? It's not some exotic, complicated financial product reserved for the ultra-wealthy. In fact, it's something you've probably heard of but likely never understood in this context. It's called a home equity line of credit, or a HELOC. Now I need you to do me a favor. Forget everything you think you know about HELOCs. Most people, and even most financial advisors, view a HELOC as a secondary tool. It's something you get after you have a mortgage, and you use it to borrow more money for a kitchen remodel, to consolidate credit card debt, or to pay for a vacation. That's like using a Formula One race car to go grocery shopping. You're using an incredibly powerful and efficient financial engine for a trivial task, and you're completely missing its true purpose. The first and most important thing to understand is that a HELOC is not a loan in the same way a mortgage is. A mortgage is a structured, amortized loan. A HELOC is a revolving line of credit. Think of it like a specialized, high-powered checking account that's secured by the equity in your home. When you're approved for a HELOC, the bank doesn't just hand you a giant check for $300,000 that you immediately start paying interest on. Instead, they give you access to a line of credit up to a certain limit. You only draw what you need when you need it, and this is the critical part, you only pay interest on the outstanding balance you've actually used. This is the first major mind shift. A mortgage immediately saddles you with a mountain of debt. A HELOC gives you access to capital. It's a fundamental shift from a liability-first mindset to an asset-first mindset. You are no longer just a debtor. You are the manager of your own capital account. But the real secret weapon, the feature that blows the entire mortgage model out of the water, lies in how the interest is calculated. As we just established, your mortgage uses a pre-calculated amortization schedule. The bank decides on day one how much interest you owe for the month, and nothing you do during that month can change it. Your HELOC, on the other hand, operates on a principle of simple daily interest. Let me say that again because it is the key that unlocks everything. Simple daily interest. This means the bank calculates the interest you owe every single day, based on that day's specific balance. This tiny, seemingly insignificant difference in accounting has monumental consequences for your financial freedom. It means that every single dollar you deposit into that account, on any day of the month, goes to work for you instantly. Let's make this real. Imagine you have a $200,000 balance on your HELOC. On the 15th of the month, your $5,000 paycheck is direct deposited into the account. The very second that money hits, your principal balance drops to $195,000. For the remaining 15 days of the month, the bank is calculating interest on that new lower balance. Your money didn't just sit there. It immediately went on the attack, reducing the principal and lowering your interest costs for the rest of the month. Now, compare that to the mortgage. With a mortgage, that same $5,000 paycheck would land in your separate checking account, where it earns maybe 0.01% interest if you're lucky. It sits there idle doing nothing. Meanwhile, your $200,000 mortgage balance is over here, completely unaffected, continuing to rack up interest at the full pre-calculated amount for the entire month. Your money is on the sidelines while your debt is on the field scoring points for the bank. This isn't a small tweak. This is a seismic shift in financial efficiency. It turns every dollar you earn into a soldier in the war against your debt, working for you 24 hours a day, 7 days a week. This is where the strategy comes into focus, and it's so simple it almost sounds too good to be true. You stop separating your finances. You stop having your income go into one bucket, a checking account, and your debt sit in another, a mortgage. You combine them. The HELOC becomes your primary financial vehicle. It becomes your new checking account. Here's how it works. You arrange for your entire paycheck to be direct deposited into your HELOC. All of it. The immediate effect is that your loan principal is massively reduced by the full amount of your income. Your cash is no longer sitting inert in a checking account earning nothing. Instead, by parking your entire cash flow inside the HELOC, you are effectively earning your loan's interest rate on that money. If your HELOC rate is, say, 7%, every dollar of your paycheck that sits in that account is saving you 7% in interest charges. That is a guaranteed, risk-free, tax-free return that is mathematically impossible to find anywhere else. Then throughout the month, you pay all your bills directly from the HELOC. You use a debit card linked to the account for groceries. You write checks from it to pay the utility bills. You set up automatic payments for your car loan. It functions exactly like the checking account you already use. Of course, as you spend money, the balance goes back up. But here's the key. For the majority of the month between paychecks, a huge chunk of your income is sitting in that account, holding the principal balance down. Your average daily balance throughout the entire month is dramatically lower than it would be with a static mortgage. And because interest is calculated daily on that lower average balance, your total interest cost plummets. You are weaponizing your cash flow. You are using the money you were already going to earn and spend anyway to actively cancel out your interest charges day by day. Now, I know the big question looming in your mind. It's the number one objection, the knee-jerk reaction that traditionalists have to this strategy. But wait a minute. HELOCs have variable interest rates. My mortgage has a 30-year fixed rate. Isn't that safer? It's a perfectly logical question, but it's based on viewing this new strategy through the old, broken lens of a 30-year amortization. With a traditional mortgage, the rate is everything. It has to be. You are signing up to be in debt for 3 decades. A quarter of a percentage point difference in the rate can mean tens of thousands of dollars over that enormous time span. You are playing a long, slow, defensive game, so locking in a stable rate feels like the safest move. But we are not playing that game anymore. We are playing a game of speed. The entire objective of this strategy is to pay off the principal with such overwhelming force and velocity that you're not in debt for 30 years. You're not even in debt for 10. When you are annihilating your principal balance every single month, the interest rate becomes less and less relevant. Think about it. The rate is just a percentage. What truly matters is the number that the percentage is applied to, the principal balance. Which scenario is better? A low, safe fixed rate of 5% on a $300,000 balance that barely shrinks for the first decade? Or a variable 7% rate on a balance that is dropping by thousands every month and is on a trajectory to hit zero in under 10 years? The math is not even close. The total interest paid in the second scenario is a tiny fraction of the first. By attacking the principal with such aggression, you rob the interest rate of its power. A variable rate going up a point is scary when you have a massive balance you'll be carrying for decades. It is a minor annoyance when you're on track to wipe out the entire debt in a handful of years. You are fundamentally de-risking the loan not by fixing the rate, but by eliminating the principal. So we've established the tool. A simple interest revolving line of credit. And we've established the core concept. Using that tool as your primary financial account to make every dollar you earn fight against your loan's principal every single day. This isn't just a different loan product. It's a complete re-engineering of your personal cash flow. You stop letting your money sleep on the job. You put it to work. But what does this actually look like in the real world? Talk is cheap. What are the numbers? How can this simple act of depositing your paycheck and paying your bills from one central account really translate into paying off a $400,000 home in 8 or 9 years instead of 30? That is where the power of this concept becomes undeniable. And in the next part, we are going to do just that. We're going to pull out the calculator and walk through a side-by-side, step-by-step comparison. We'll take a typical American family with a typical income, a typical house, and typical expenses. We'll run one version of their life through a traditional 30-year mortgage, and the other through this HELOC strategy. The results, I promise you, will be more than surprising. They will change the way you look at debt forever. Let's meet the Smiths. They're a fantastic, hardworking couple, probably a lot like you or your neighbors. They have a combined household income of $100,000 a year. After taxes, insurance, and retirement contributions, they take home about $6,700 a month. They're disciplined savers, and they've managed to put away $75,000 for a down payment on their dream home. They find the perfect house, priced at $400,000. In our first scenario, the Smiths do what 99% of Americans do. They go to a bank, put down their $75,000, and take out a traditional 30-year fixed-rate mortgage for the remaining $325,000. Let's say they lock in a respectable interest rate of 6%. Their monthly payment for principal and interest comes out to $1,948. Add in another $600 for property taxes and homeowner's insurance, and their total house payment is $2,548 a month. Now, let's look at what happens in that very first month. The Smiths are excited. They make their first mortgage payment of $1,948. They feel a sense of pride, of ownership. But here's the brutal truth: the bank doesn't advertise on a billboard. Of that nearly $2,000 payment, how much do you think actually went to paying down their $325,000 loan? $1,000? $500? Try $173. That's it. A measly $173. The other $1,775 was pure interest, vanishing into the bank's coffers. This is the sinister genius of an amortized loan. For the first decade or more, you're basically just renting money from the bank. Your payments are almost entirely interest. You're a hamster on a wheel, running as fast as you can, but the cage isn't moving. The Smiths work hard all month. Their $6,700 paychecks come in. They pay their $2,548 house payment. They spend another $3,000 on groceries, gas, utilities, car payments, and the occasional dinner out. At the end of the month, they have about $1,150 left over, which they dutifully put into a savings account, earning a pathetic fraction of a percent in interest. Year after year, this cycle repeats. Their paychecks go into a checking account that pays them zero interest. Their savings sit in an account earning next to nothing. Meanwhile, their mortgage is a giant, unmoving monster, siphoning off their wealth in the form of interest, 1 month at a time. After 5 full years of making payments, a total of $116,880 out of their pockets, they will have paid down their loan balance by only about $20,000. The other $96,000? Gone. Vaporized as interest. They're trapped in a 30-year financial sentence, and they don't even know it. This is the standard path. This is financial normalcy in America. Now let's rewind. Let's go back to the day the Smiths bought their house and run a second scenario. They get the exact same $400,000 house, make the same $75,000 down payment, and take out the same $325,000 mortgage at 6%. But this time they make one single strategic change. On the very same day they close on their mortgage, they also open up a home equity line of credit, a HELOC, for as much as the bank will give them, let's say $50,000. This HELOC is now their primary financial tool. It's not just a loan. It's a high-powered dynamic checking account. They link their direct deposit to it. They get a debit card and checks for it. It becomes the hub of their entire financial life. Here's where the magic begins. Their $6,700 monthly income is now deposited directly into the HELOC. Remember, a HELOC is a line of credit. When you put money in, it pays down the balance you owe. So the moment their paycheck hits, the $50,000 balance they might have on the HELOC is instantly reduced to $43,300. Now they live their life just like before. They use the HELOC's debit card to buy groceries. They write a check from the HELOC to pay the electric bill. They pay their car payment from the HELOC. And, most importantly, they pay their $2,548 mortgage payment directly from the HELOC. As they spend throughout the month, the balance on the HELOC slowly creeps back up from $43,300 to its original $50,000. You might be thinking, so what? The money came in and the money went out. What's the difference? The difference is everything. It's the difference between a leaky bucket and a sealed vault. It lies in a concept called average daily balance. A traditional mortgage calculates interest on a monthly basis, based on a preset amortization schedule. It doesn't care what you do with your money during the month. Your checking account where your money sits idle is a dead tool. It does nothing for you. But a HELOC calculates interest daily, based on that day's balance. It's a living, breathing account. By dumping their entire paycheck into the HELOC, the Smiths drastically lowered the loan's balance for the majority of the month. Even though they spent the money eventually for those 3 weeks before all the bills were paid, their income was actively working against their debt. That $6,700 wasn't sitting lazily in a checking account. It was deployed as a debt-destroying soldier, canceling out interest every single second of every single day. Think of it this way. In the first scenario, their money sat in a checking account like a lazy employee, earning nothing, while the mortgage monster across the street ate interest payments for breakfast. In the second scenario, their money is a hyper-efficient employee that lives inside the monster's own house, fighting it from the inside out, 24/7. This process of using cash flow to lower the average daily balance is called an interest cancellation. The Smiths are using the same income and the same expenses, but they're structuring it to cancel out a huge portion of the interest they would have otherwise paid on their HELOC. Now here's the masterstroke. Remember that $1,150 they had left over at the end of the month in scenario 1? In this new scenario, that money doesn't get moved to a separate savings account. It just stays in the HELOC. It remains there, further suppressing the balance and canceling out even more interest. So at the end of month 1, the balance on their HELOC isn't $50,000. It's $48,850. The next month, their paycheck comes in and knocks that balance all the way down to $42,150. The cycle repeats, but every single month the starting balance is lower, the average daily balance is lower, and the amount of their own money working for them is higher. The debt gets smaller and smaller, like a snowball rolling downhill, but in reverse. It's a debt-destroying vortex powered by their own income. Within a relatively short period, let's say 2 years, they've used this method to completely pay off the $50,000 HELOC. But they don't stop there. Now they take a $50,000 chunk from their fully available HELOC and make a massive lump sum payment directly to the principal of their main mortgage. Their $325,000 loan is now a $275,000 loan overnight. They just skipped over years of interest payments in a single transaction. Then they simply repeat the process. They use their cash flow to rapidly pay down the HELOC again. And once it's paid off, they fire another cannonball at the mortgage principal. This isn't just paying a little extra on your mortgage. This is a strategic, surgical strike on the very engine of the bank's profit machine. The amortization schedule. They are turning the bank's own tools against them. In just the first 2 years, the Smiths in scenario 2 have obliterated over $60,000 of their mortgage principal. The Smiths in scenario 1? They've barely cleared $8,000. It's not even a fair fight. One couple is taking a staircase, paying the bank for every single step. The other has found an elevator, and they're heading straight to the top floor. Complete and total debt freedom. And they're just getting started. It's not even a fair fight. One couple is taking a staircase, paying the bank for every single step. The other has found an elevator, and they're heading straight to the top floor. Complete and total debt freedom. And they're just getting started. You see, for the couple with the traditional mortgage, paying off the house is the end of the journey. It's the finish line. They get the t-shirt, the pat on the back, and the right to finally, after 30 long years, say the house is truly theirs. But for the couple who used the HELOC strategy, paying off the house isn't the finish line. It's the starting block. It's the moment the real race begins. Let's check back in on our two families. Couple A, the traditionalists, are now 10 years into their 30-year mortgage. They're doing everything right. They've never missed a payment. They've built up a little bit of equity. They feel secure. But they're still on that staircase, faithfully making their monthly trek, sending thousands upon thousands of dollars in interest to the bank every single year. Their home is a place to live. It's a source of pride. But financially, it's a giant hungry liability that eats a huge chunk of their income every month. Now let's look at couple B. It's the same point in time 10 years later. But their reality is a universe away. They paid off their entire mortgage in about 7 years using the HELOC strategy. For the last 3 years, they haven't made a single mortgage payment. Think about that. Imagine your single biggest monthly expense vanishing. What would you do with that extra $2,000, $3,000, maybe $4,000 a month? For couple B, that money isn't just disappearing into lifestyle upgrades. It's being stockpiled. It's fuel. Because they still have their HELOC. It's sitting there with a zero balance, a powerful financial engine waiting to be turned on. Then one day an opportunity pops up. A house in a nearby neighborhood goes on the market. It's a foreclosure, needs a bit of cosmetic work. But the bones are good and the location is fantastic for rentals. The numbers are almost too good to be true. The asking price is $250,000. To get an investment loan, they'll need a 20% down payment. That's $50,000. Couple A sees the same listing. They talk about it over dinner. Wouldn't that be nice? They say. Imagine having a rental property. Passive income. But for them it's just a dream. $50,000 in cash? They don't have that just sitting around. All their extra money has been going towards their mortgage, paying down a tiny sliver of principal and a huge chunk of interest. Their equity is trapped inside their home like a genie in a bottle. To get it out, they'd have to go to the bank, apply for a home equity loan or a cash-out refinance. A process that would take 45 to 60 days, involve mountains of paperwork and thousands in fees. By the time they'd get approved, that great deal would be long gone, snapped up by someone who could move fast. Couple B sees the listing and they don't just dream. They act. They already have access to their capital. They have their HELOC. They don't need to ask the bank for permission. They don't need to fill out an application. They don't need to wait. They simply write a check directly from their HELOC account for $50,000 and make a cash-competitive offer on the rental property. While Couple A is still dreaming, Couple B is signing the purchase agreement. Let's break down exactly how this magic works. They draw $50,000 from their HELOC for the down payment. They then get a standard investment property mortgage for the remaining $200,000. Now I know what you're thinking. They just got out of debt. Now they have 2 new loans? This is the critical mindset shift. They are not taking on consumer debt. They are strategically using debt to acquire an asset that produces income. Let's run the numbers. Their HELOC has a variable rate. Let's say it's at 8% right now. The interest-only payment on the $50,000 balance is about $333 a month. The new mortgage on the rental property, the $200,000 loan. Let's say they lock in a 7% rate for 30 years. The principal and interest payment on that is about $1,330. So their total monthly cost to hold this new property is the HELOC interest plus the new mortgage payment. That comes out to $1,663. But here's the beautiful part. The property immediately rents for $2,200 a month. So every single month they collect $2,200 from their tenant. They pay the $1,663 for the 2 loans. And they are left with $537 in positive cash flow. That's an extra $537 in their pocket every single month from an asset that someone else is paying for. But they're smarter than that. They don't just pocket the cash. What do they do with that extra $537? They take it, along with any other extra money they can find in their budget, and they fire it directly at the $50,000 HELOC balance. It's the exact same strategy they used to pay off their primary home, but now they're using their tenants' rent money to do it. The rental property isn't just paying for itself. It's actively and aggressively paying off the debt that was used to acquire it. In a few short years, that $50,000 HELOC balance is paid back down to zero. And what happens then? Their full line of credit is available again. They can go out and do the exact same thing again. Buy another rental. And another. This is how real generational wealth is built. It's a rinse and repeat system. They are using the bank's money, leveraged against an asset they already own, to buy more assets that generate income, which then pays back the bank's money at an accelerated rate. It's a perfect, self-perpetuating wealth machine. Meanwhile, couple A is still on the staircase. Year 10, year 11, year 12, faithfully sending their payments to the bank, watching their net worth inch up by the value of their principal payment, while couple B's net worth is exploding. They own their primary home free and clear. They own a rental property that's generating passive income and building equity. And they're already on the hunt for the next one. The difference isn't that one couple is smarter or works harder than the other. The difference is the tool. Couple A chose a financial tool, the 30-year mortgage, that is designed from the ground up to be slow, inefficient, and incredibly profitable for the bank. It treats your home like a piggy bank with the slot so small, you can barely fit a dime in. Couple B chose a tool, the HELOC, that is designed for speed, flexibility, and control. It treats your home like a financial headquarters, an asset that can be deployed to capture opportunities. It's the difference between owning a horse and buggy versus owning a private jet. Both might eventually get you to your destination, but one gets you there in a fraction of the time with a world of other destinations suddenly within reach. Now the critics will scream, "That's too risky. You're leveraging your home. What if the tenant stops paying? What if the market crashes?" And those are valid questions. But risk is not about the tool. It's about the user. A power saw in the hands of a master carpenter can build a beautiful home. That same saw in the hands of a fool can cause a disaster. The HELOC is a power tool. It must be respected. Couple B isn't using their home equity to fund vacations or buy luxury cars. They are following a strict, calculated plan to acquire income-producing assets. They have cash reserves. They vet their tenants. They buy properties where the numbers make sense even in a down market. They are not gambling. They are executing a strategy. The gap between these two families is no longer just a staircase versus an elevator. Couple A is still on the ground floor, dutifully polishing the bank's brass plaque. Couple B is on the top floor, looking out the window not at the horizon, but at the empty lot next door, drawing up the blueprints for the skyscraper they're about to build. And the key that unlocked it all, the foundation for their entire financial empire, was understanding one simple, powerful truth about the money they borrowed. That truth is that not all debt is created equal. The very structure, the DNA of the loan you take, determines whether it will be a ball and chain shackled to your ankle for 30 years, or a jetpack that can launch you toward your financial goals. See, when you get a mortgage, you're not just borrowing money. You're entering into a very specific, very rigid contract called an amortization schedule. That's a fancy word, but what it means is simple, and frankly, a little terrifying when you truly grasp it. Imagine your mortgage is a giant block of ice, and your monthly payments are a tiny ice pick. For the first several years, you're not really chipping away at the block. You're just chipping away at a thick layer of frost that keeps reforming every month. That frost is the interest. The bank gets paid first, and they get paid the most at the beginning. On a typical 30-year, $500,000 mortgage, you could make payments for 5 straight years. That's 60 payments, tens of thousands of dollars out of your pocket, and find that you've only paid off a tiny fraction of the actual loan. The vast majority of your money, your hard-earned capital, didn't build your wealth. It built the bank's. The amortization schedule is designed for the lender's security. It ensures they recoup their profit up front. It's a one-way street. You pour money in, and it gets locked away, slowly, painstakingly reducing a number on a piece of paper over the course of decades. Now let's look at the HELOC. The home equity line of credit isn't a predetermined, rigid block of ice. It's a reservoir of water. It's liquid. This is the fundamental difference that changes everything. During what's called the draw period, which is often the first 10 years of the loan, you typically have the option to make interest-only payments. Let me say that again because it is the secret key to the entire kingdom. Interest-only payments. This doesn't mean you should only pay the interest. It means you can. You have the control. The power of choice has been transferred from the bank's rigid schedule back to you. Let's put this into real numbers. Let's say the interest-only payment on your HELOC is $700 this month. But you had a great month at work, and you have an extra $3,000 you want to use to pay down debt. With a mortgage, you could make an extra payment. That $3,000 goes into the mortgage machine. It chips off a little more principal, and might shave a few months off the end of your 30-year sentence. But that money is gone. You can't get it back next month if your air conditioner dies. It has been consumed by the amortization schedule. With the HELOC, you put that extra $3,000 toward the principal. Instantly, the balance on which your interest is calculated drops by $3,000. Your interest payment for the very next month will be lower because of what you did today. The effect is immediate. But here is the earth-shattering difference. If that air conditioner dies next month and you need $3,000 for a new one, you can simply draw it right back out. The money was never truly gone. It was just parked in a place where it was actively working for you by reducing your interest costs while remaining completely accessible. It transforms your home equity from a static, illiquid number trapped in your house into a dynamic, flexible financial tool. It's the difference between having your savings cemented into the foundation of your house versus having it in a high-yield checking account that you can access at any time. This is what our couple understood. They realized their mortgage was a defensive tool. It was about slowly, passively getting out of debt over a lifetime. The HELOC was an offensive weapon. It was about actively, strategically using capital to build wealth now. They stopped thinking like debtors and started thinking like investors. The question was no longer, how can I make my $2,800 mortgage payment this month? The question became, my interest cost this month is only $700. How can I use the other $2,100, plus any other capital I have, to acquire an asset or make an investment that will generate more than the cost of this debt? They turned their biggest liability, their house, into their greatest asset. Not by waiting for it to appreciate, but by unlocking the equity trapped inside and putting it to work. This is the skyscraper. The mortgage is the slow, steady process of laying one brick every single day for 30 years, following a blueprint someone else designed for you. The HELOC is like having a crane and a direct line to the steel factory. You can build an entire floor in a week, use the rent from that floor to order more steel, and build the next one even faster. You control the pace. You control the flow of materials. You are the architect of your own financial future, not just a tenant in a plan designed by a bank. But this power, this incredible flexibility, comes with a profound responsibility. This is not a magic wand. It's a power tool. And like any power tool, it can build a masterpiece or it can cause a catastrophic injury. The freedom to make interest-only payments is also the freedom to be incredibly foolish. Many people fall into the trap. They use their HELOC like an ATM for vacations, new cars, and lifestyle upgrades. They only pay the interest month after month, year after year, never touching the principal. They're running on a treadmill, paying for the privilege of being in debt without ever actually reducing it. And then the draw period ends. Suddenly the rules change. The loan converts and they are required to start paying back the principal and the interest, often over a shorter time frame and at a variable rate that may have climbed significantly. Their payment can double or even triple overnight, and they are caught in a financial tsunami they never saw coming. Our couple avoided this. They respected the tool. They were disciplined. They understood that every dollar they drew from that HELOC had to have a mission. It had to be deployed with a clear plan to generate a return, whether that was through a cash-flowing rental property, a small business investment, or another strategic play. They weren't using their house to fund their lifestyle. They were using the capital from their house to fund their freedom. They had the blueprint for the skyscraper and the powerful crane to build it. But building in the volatile world of finance requires more than just good materials and equipment. It requires a strategy that can withstand storms, a strategy that can turn market turbulence from a threat into an opportunity. And the specific strategy they used was so elegant, so counterintuitive, it would fundamentally change the way you look at every dollar you earn and every debt you owe. This strategy wasn't about complex stock market plays or finding some obscure investment. It was about financial aikido, using the weight and momentum of the banking system against itself. The Williams family realized the single most inefficient part of their entire financial life was their checking account. Think about it. Your entire income, every single dollar you earn, flows into this account and sits there, sometimes for days, sometimes for weeks, earning virtually zero interest. Meanwhile, just a few virtual feet away on the bank's ledger, you have this massive mortgage debt and other loans accruing interest every single day. Your money is sleeping on the job while your debt is working overtime against you. The Williams epiphany was this: what if we fire the checking account? What if we could make every single dollar start fighting debt the second it comes into our possession? And that's exactly what they did, using their home equity line of credit. They transformed their HELOC from a simple emergency fund into the central hub of their entire financial world. Here's how it worked. First, they arranged for their paychecks to be direct deposited not into their checking account, but directly into their HELOC. Let's say their monthly take-home pay was $8,000. On payday, that entire $8,000 was deposited straight into their HELOC. If they had a $20,000 balance on the HELOC, it instantly dropped to $12,000. From that very second, they were only paying interest on $12,000, not $20,000. Then they paid all their monthly expenses, their groceries, their gas, their utility bills, their car payments, directly out of the HELOC. Most HELOCs come with check writing privileges or a debit card, so functionally, it operated just like a checking account. As they spent money throughout the month, say $6,000 in total, the balance would creep back up from $12,000 to $18,000. But look what happened. For the entire month, their average daily balance on that HELOC was significantly lower than it would have been otherwise. Their income was constantly suppressing the loan balance, minimizing the interest they paid. They had weaponized their cash flow. Instead of their income sitting idle in a checking account, it was actively reducing their debt principal every single day. But that was just the first step. That was the elegant part. The counterintuitive part was how they used this new system to attack their primary mortgage. Their mortgage was a $300,000, 30-year fixed-rate loan. Like most mortgages, it was an amortized loan, which is a fancy way of saying it's heavily front-loaded with interest. In the early years of a mortgage, the vast majority of your payment goes to the bank's profit, to interest, while only a tiny sliver chips away at the actual loan principal. It's the silent killer of wealth building. The Williams understood this. They knew that a dollar paid to principal in year 3 of a mortgage was infinitely more powerful than a dollar paid in year 23, because it saves you decades of compounding interest on that single dollar. So here's what they did. After running their finances through the HELOC for a few months, they had their system down. Their $8,000 of income came in, their $6,000 of expenses went out, leaving them with a $2,000 surplus each month. This surplus, combined with the interest savings from their cash flow strategy, meant the balance on their HELOC was dropping fast. After 10 months, they had paid their HELOC down by $20,000. Now they made their move. They took a $20,000 draw from their HELOC and made one massive lump sum principal-only payment directly to their mortgage. In an instant, their $300,000 mortgage balance dropped to $280,000. But it was so much more than that. By paying that $20,000 directly to principal, they didn't just shorten their loan, they vaporized entire future payments from their amortization schedule. They leapfrogged over years of interest-heavy payments and landed years ahead. The bank's amortization schedule was a carefully constructed 30-year plan to maximize interest payments. The Williams had just thrown a grenade into that plan. They essentially erased over 72 future payments from the end of their loan, saving themselves over $60,000 in future interest with that single transaction. Now I know what you're thinking. Didn't they just rob Peter to pay Paul? Didn't they just replace $20,000 of good mortgage debt with $20,000 of bad, higher interest rate HELOC debt? And on the surface, that's a fair question. But it misses the genius of the strategy. Yes, the HELOC balance went back up by $20,000. But remember their system. Their entire $8,000 monthly income was still flowing directly into that HELOC, immediately pushing that balance down. They were using the full force of their gross income to pay down a simple interest, revolving line of credit. A mortgage is a static, amortized loan. A HELOC, when used this way, is a dynamic financial tool. The interest is calculated on the average daily balance, which their income was constantly suppressing. They repeated this process. Every time they paid the HELOC down by a significant chunk, $10,000, $15,000, $20,000, they would take that amount, fire it at the mortgage principal, and then focus the full force of their cash flow on paying the HELOC back down again. It was a cycle, a rinse and repeat strategy of chunking down their mortgage. Now let's go back to the market turbulence we talked about. While their neighbors were watching their home values on Zillow drop and seeing their paper equity evaporate, the Williams were in a completely different reality. They were manufacturing their own equity. Every $20,000 chunk payment they made was $20,000 of guaranteed, real equity that had nothing to do with market fluctuations. It was equity they created through pure financial efficiency. As the market dipped 10%, their neighbors who had 10% equity were suddenly underwater, owing more than their house was worth. They were trapped. The Williams, however, had already paid down $60,000 of principal in just a few years. Their loan-to-value ratio was plummeting. The market downturn was just a number on a screen to them, because their financial foundation, their actual ownership stake in their home, was growing stronger every single month. This gave them something more valuable than money: peace of mind and options. While others were forced to stay put or were facing foreclosure, the Williams had a fortress of equity. Their HELOC, which they were rapidly paying down, represented a huge, accessible source of liquidity. When the market finally bottomed out, and a rental property went up for a fire sale price down the street, who do you think had the available capital to take advantage of that opportunity? Not the people trapped by their underwater mortgages. It was the Williams. They had turned their home from a simple liability, a place to live, into a dynamic engine for wealth creation, one that insulated them from fear and empowered them to act when everyone else was paralyzed. This is the profound difference. A mortgage is a tool for the bank. A HELOC can be a tool for you, but this financial superpower isn't without its risks. It requires immense discipline. There are 3 critical mistakes that can turn this wealth-building engine into a catastrophic debt trap. And the first one is so subtle, so psychologically tempting, most people don't see it until it's far, far too late. The first mistake is treating your home like an ATM for lifestyle inflation. Starts innocently. You've been paying your mortgage for years. You see that equity number on your statement and it feels like found money. You've been responsible. You've sacrificed. You deserve a reward. So you open a HELOC. The bank makes it so easy. Suddenly, you have access to $50, $100, maybe $200,000. And the little voice in your head starts whispering, "That kitchen remodel we've always dreamed of? The one with the marble countertops and the 6-burner stove? We can do it now. It'll add value to the house, right?" But you're not really thinking about a dollar-for-dollar return on investment. You're thinking about how great it will feel to host parties in that kitchen. Then it's the vacation. Not just a week at the beach, but that 2-week European trip. The one you saw on Instagram. We'll pay it back over time, you tell yourself. It's a life experience. Then it's a new car because the payment on the HELOC is so much lower than a traditional car loan. Each purchase is justified in isolation. Each one feels earned. But you're not building wealth. You're liquidating it. You are systematically converting the most stable, powerful asset you own, your home equity, into depreciating assets and fleeting experiences. You're taking the solid bricks of your financial foundation and trading them for sand. The danger is that it feels painless. There's no big check to write, just a simple transfer from your HELOC to your checking account. It's a silent erosion of your net worth, masked by the temporary high of consumption. You're raising your standard of living by lowering your long-term financial security, and by the time you realize it, you've turned a decade of diligent mortgage payments into a mountain of consumer debt, secured by the one thing you can't afford to lose: your home. This leads directly into the second catastrophic mistake: falling for the interest-only illusion. During the initial draw period of a HELOC, which typically lasts 10 years, most lenders only require you to pay the interest on the money you've borrowed. This is the siren song of the HELOC. Feels like free money. Let's imagine you draw $50,000 for that kitchen remodel and vacation. If your variable interest rate is, say, 7%, your minimum monthly payment is only about $290. $290 a month for 50 grand. Feels incredibly affordable. Feels like a hack. You think, I can handle this forever. But forever has an expiration date. It's called the end of the draw period. And for millions of homeowners, it's a financial cliff they don't see coming until they're falling off of it. After those 10 years are up, the loan enters the repayment period. Two things happen simultaneously, creating a perfect storm of payment shock. First, you can no longer borrow any more money. The line of credit is closed. Second, and far more terrifying, your payment is recalculated. You now have to pay back not just the interest, but the entire $50,000 principal, amortized over the remaining term of the loan, usually 15 or 20 years. Suddenly, that manageable $290 payment explodes. That same $50,000 balance, now being paid over 15 years at the same 7% interest, becomes a monthly payment of nearly $450. Or if the term is 10 years, it's closer to $580. And that's if interest rates haven't gone up. If rates have risen to 9%, that payment is now over $630. It more than doubles overnight with no warning if you weren't reading the fine print. Now imagine you didn't just borrow $50,000. Imagine over 10 years of lifestyle creep, You racked up a balance of $100,000. Your interest-only payment was a manageable $580 a month. But when the repayment period hits, your new payment, principal and interest, skyrockets to over $1,150 a month. It's an economic earthquake that shatters your household budget. This is how foreclosures happen. People get so used to the artificially low interest-only payment that the real payment becomes an impossible burden. They were treading water for 10 years, not realizing they were drifting into the middle of the ocean. And the moment the repayment period begins, the storm hits. But even that pales in comparison to the third mistake, the one that can bankrupt you with breathtaking speed. Gambling with your equity. This is the mistake of the speculator, the person who sees their home equity not as a safety net, but as a stack of chips for the casino. They hear stories of people getting rich in the stock market, in crypto, or by flipping houses. They get a brilliant, terrible idea. Why use my own cash? I'll use the bank's money. I'll use my HELOC. They draw $80,000 against their home and dump it into a hot tech stock, a speculative cryptocurrency, or a down payment on an investment property they plan to flip. For a moment it feels brilliant. They're leveraged. They're playing in the big leagues. Then the market turns. It always does. The tech stock plummets 40%. Their $80,000 investment is now worth $48,000. The crypto coin they bought collapses and it's worth next to nothing. The real estate market cools and they can't sell the flip property for a profit. In fact, they're losing money every month on the mortgage. Here's the devastating reality. Even though their investment has vanished, the $80,000 HELOC debt is still there. It is very, very real. And it is still secured by their family home. They didn't just lose their bet. They put a lien on their children's bedroom. And it gets worse. Because HELOCs have variable interest rates, when financial markets get volatile, the Federal Reserve often raises interest rates to combat inflation. So at the exact moment their speculative asset is crashing in value, the cost of the debt they used to buy it is actively increasing. Their monthly HELOC payment starts climbing month after month. They are trapped in a financial vice, squeezed from both sides. Their investment is gone, and the debt is becoming more expensive. This is a level of financial stress that destroys marriages, ruins health, and leads to utter financial ruin. It's the single fastest way to turn the American dream of homeownership into a waking nightmare. So, after all these warnings, what's the answer? Is a HELOC simply a financial instrument of destruction? No, absolutely not. When used correctly, it remains one of the most powerful and flexible financial tools an American homeowner can possess. The difference is not in the tool, but in the mindset of the person wielding it. A HELOC should be treated not as a credit card, but as a strategic business loan where the business is your family's financial future. You use it for one of three reasons and one of three reasons only. 1, for strategic, high return on investment home improvements. Not the dream kitchen for entertaining, but the new roof that stops a leak, the high-efficiency windows that slash your utility bills, or the addition that adds verifiable square footage and market value far in excess of its cost. You are investing in the asset itself. 2, as a surgical tool for a specific short-term financial opportunity, like a bridge loan to secure your next home before you've sold your current one, with a clear and immediate repayment plan. And 3, as a break glass in case of emergency fund. It sits there with a zero balance costing you nothing. But if a true catastrophe strikes, a major medical emergency, a sudden job loss, you have immediate access to capital at a much lower interest rate than credit cards or personal loans, giving you the breathing room to get back on your feet. Your home equity is the financial fortress you have spent years of your life building, one mortgage payment at a time. It represents security, stability, and the bedrock of your family's wealth. A mortgage is the slow, disciplined process of laying each and every one of those stones. A HELOC in the right hands can be used to build a strong watchtower on top of that fortress, improving its value and utility. But in the wrong hands, it becomes a demolition charge placed at its very foundation, ready to blow the whole thing to pieces. The power to build or to destroy isn't in the loan itself. It's in the wisdom, the discipline, and the foresight of the person who signs the papers. The choice is yours.